Welcome, everybody, to the Tuesday edition of the Not Your Average Investor Show with Bill Fox, who's been investing in real estate since the 90s. He has bought and held rental properties. He's flipped. He's done Airbnb. He's done it all. And we're going to pick his brain today. As tradition goes, we are live on Facebook. It is Tuesday, the Not Your Average Investor Show. I am your host, Pablo Gonzalez. With me, my co-host, the man they call GC because he generates cash flows, because he's got genius concepts, because he's a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you.
And you've been hearing from him already. He's not a shy man, and he is not short on experience. He's been investing in real estate since the 90s, man. This guy's got stories for decades, from buying VA houses, from flipping homes, from buying and holding rental income properties, from doing Airbnbs, coming to us from Gainesville, Florida. Bill Fox, welcome, Bill. Say hello to everybody, please.
Hello, everybody. Nice to meet you all.
It is good to have you here, Bill. I know that you and I have talked a couple of times over the past couple of weeks, and I'm really pumped to get into your brain and your real estate knowledge. I want to welcome our community who's already in the house: John Henning, Lee Bishop, Eddie Harris from Hotlanta, Mark Lara back again. Mark, you're officially a regular. Mark, you get that badge now. Bill Shields is back, surfs up at Bill's place. He says, I'm with you, Bill. I'll be out there this afternoon too. Ken Moline, another past star from the show. Joan Farwell. Hi, Joan. Nice to see you. Leo from California. Good to see you. Great to have everybody in the house. As you all know, this is an interactive show. We want you interacting with each other in the chat, and we want you interacting with us in the Q&A. So the trick to the chat is that when you first pop it open, it only defaults to speak to us. So sometimes that catches some of our veterans. For example, Bill, you're only talking to us. It's only talking to panelists. Joan, you're only speaking with us. The trick there is to grab that blue box right above where you tap and change it from panelists to panelists and attendees, so everybody can speak with each other, make a new friend in the chat. There's a ton of real estate knowledge just in the chat alone. We're already up to almost 40 people in there. So don't lose the opportunity to get wisdom from the audience. And if you want the wisdom straight from Bill and GC's brain, the move is to pop open the Q&A box, put your question in there, and that's the easiest way for me to see it, right? Like there's two separate places. You see the chat moves a lot. The Q&A holds there steady for me, so I don't go cross-eyed when I'm trying to keep that conversation going. And last but not least, if you just want a quick, primer on what it is to, truly create passive wealth, go to jwbpassiveguide.com, download that. That should get you started on the journey of understanding everything that JWB does. But right now, we are here to understand what Bill Fox does. Bill, you were telling us the story. It's the 90s. You're buying some VA repos. Start us from the top there of just how you got into real estate early on.
Well, my CPA at the time had introduced us to VA repos, and we were bidding on them. And fortunately, we bought one, and it was really easy turnover. They were getting them ready for you inside. It wasn't much work to do, and I had been a property manager before I even moved to Florida. And so I said, this is pretty easy. And so bought another one and did it. And gradually we bought 4 in the course of a year, but each time VA did a little bit less in getting them ready to rent out. And they were getting more expensive to buy in the auction basis. So we bought the 4 and started renting them out. And it was, in the beginning, doing very, very well. We were successful in getting them rented. It was easy. They're on the west side of Jacksonville. We liked that area. They were nice houses, 3-bedroom, 2-bathroom houses, and in popular demand. Then after a year or so, we started having turnover, and then some maintenance issues and setting different things up that started. And it wasn't as easy as we thought it was, the management. And progressively, we'd have to go through the whole process of getting new people in and getting them fixed. So about 2004 to 2005, with the 4 houses, we were just so busy with my business and everything. I sold 2 of the houses. I told my wife, I can't do both. I have to do one or the other. So I sold 2. So we kept 2 and it kept going. And then about 2011, 2012, we happened to see an article, and it was in the Florida Times Union, and lo and behold, it was about Gregg and Alex and their business and what they were doing. And I told my wife, we have to talk to these people. And we contacted them and we were talking back and forth, and they had some properties come up over on the east side of town. They had bought several of them over India. And we went up and stayed over a Friday night and got together with Gregg, who had people from, I was amazed, all over the country had flown in to go on a tour.
Oh, that's when we were doing the tours back in the day. Wow.
Yeah.
We those in so long. So that's when was that when we actually had everybody in the old office there and
where we couldn't find parking?
Yeah. Can you tell everybody what the old office looked like, let's say 10 years ago for JWB, because you have so much perspective here. What was it like to just drive into the parking lot and then go into the office, if you can remember?
It was a small little, it was a house, small house, basically a ranch style house. And it was off Bay Meadows, but you went to pull in and try and find a parking place. And even though they expanded, there was no place to park. So you might have to park down the street, or they'd open up a spot for you to go in and talk. And
this rule, whenever, now granted, okay, we're working with folks that live across the country and are buying assets that are $100,000 assets, $200,000 assets, and they're flying in for the first time to meet us. We, at that time, occupied a very small house. It was actually 2 units. One side prior to us moving in was a hair salon, and then one side was a massage place. And there was a jewelry studio there too.
Yeah.
So we retrofitted that and it became our office. But there were only about 12 parking spots. At that time, we managed about 500 residents, and we had probably 25 people working at JWB, somewhere around there. So whenever a guest would come in, like Bill and Ann, or any of the guests that we flew in, we politely let them know that they had to drop their keys off at the front desk, because we were going to triple park them in. And then they had to be okay with us if they were on the tour about to buy the house or whatever, that we would be okay to move their car so that we could triple park somebody else in. That's what it was like 10 years ago at JWB.
Now that you bring that up, I remember that. And we were fortunate that it was a Saturday, so there wasn't as many people in the office when we went on the tour with you. That's it. But we were impressed. It was a brand new house that they had purchased, and several of them. And we went and looked at several of them. And we said, my wife, she makes her mind up very quickly. I want to buy that house. And so we sat down and talked to Gregg and got everything going, and we purchased that house. And we still have that house, and they're still managing. That was back in 2012. Well, go ahead. I was going to say we were having problems with our other houses. And I talked to him, would you be interested in perhaps managing some of these other houses for us back then? And yeah, it worked out. It worked out. They said yes. Mike Stetson used to help us out over there, stop by, took over, and alleviated the problems as far as maintenance, rentals, applications. I mean, it just made life easier for us, so much easier.
So you own one rental property with us that you bought as a turnkey property, and then you brought a number of other properties over to us for us just to do the management on. Is that right?
Right. That's right. Right.
Yeah.
And we stayed that way for a few years. That was 2012. And we kept looking in Jacksonville because it's a viable market. But I had moved to Gainesville, back to Gainesville, still commuting to Jacksonville every day. And like I said, my son had finished up school and wanted to get involved in real estate, going to different seminars and things. And that's when things were going smoothly with Gregg and everybody running our business. So we looked at, and lo and behold, he was on buying houses on auction, or started with one. And we started flipping, which could be, an adventure. Let me put it that way, especially when you don't have contacts with vendors, contractors, and things like that. In Gainesville, that was tough for us. Where when we were dealing with JWB, we didn't have to worry about problems with maintenance or things like that. It was taken care of for us. So things were going smoothly.
Bill, can I ask, at that point, was it the wanting to have a business with your son and get something going, or was it looking for higher kind of returns per transaction? What made you want to get into the flipping business when the buy and hold stuff was going well?
Well, we had gone to various seminars over the years and spoke with several people. And, it was one of these things. My son was, like I said, he was young, out of college. He said, I can do that, and it was something he wanted to get involved with and start. So I said, okay, it sounds good. And that's what we here in Gainesville, being us living here, being a very viable market also at the time, we said, we'll get involved. And it was business that I think he wanted more than anything. Me, not so much at the time. And we did. And like I said, we started doing flips. It was flips in the beginning. And they were going to be we did about 6 in a year and a half. And it was difficult, but it was good. And then all of a sudden in 2017, how we actually started with the Airbnb, we were trying to sell one of our flip houses right before. It didn't sell before school started. We couldn't rent it. Everyone it was in August. They already had apartments set up, everybody coming to UF. But then a hurricane was coming in August, late August, early September. And my son said, why don't we put this on that thing, Airbnb? I said, what's that? And he says, I'll take care of it, Dad. Don't worry about it. So he signed it. And we had an elderly couple with their caretakers come up to Gainesville and stay for 12 days in the first Airbnb. And it worked out very well. So we had another one of our properties, which was a 3-bedroom, 3-bath condo coming up off lease. And we said, why don't we try this? And Ann had a friend that was coming to town, said, I'll rent it for 2 weeks. So Ann went out. We were supposed to be leaving for a reunion for her in the Panhandle that day and bought furniture for the whole house. We left and my son took care of it. And then that was occupied. And that was the second. And then it just kept going and going after that with different properties instead of long-term rentals, converting them into Airbnbs.
So you've got one of the leading research professionals at UF, and her main role at that time is lead stager for you at this point.
Yes. Well, she does do maintenance also. Her grandfather was a master carpenter, so she brought up working with him. So she enjoys it. She really does. She's constantly online, still buying furniture and different items for houses. And she'll say, Alex, I need you to take the truck and go pick this furniture up in Jacksonville, or I need you to go to Orlando. So that happens on occasion. We are flexible, let's put it that way, when it comes to doing things, and we work together on it. So
what a journey. I think, and for those who are watching today, many have questions about, is long-term rental property investing right for me? Is flipping houses right for me? Is short-term rental properties, short-term leases like Airbnbs right for me? So for anyone who would like to talk to somebody who has literally done all of that, make sure you fire your questions in for Bill. But Bill, let me just ask you the question. Knowing that you have spent time, money, energy, resources, you made a commitment to each of those. Talk me through maybe the pros and cons. Let's talk about the flipping, because we don't talk a lot about flipping on this show. Maybe what did you learn the most about flipping and pros and cons?
that's very difficult finding reliable vendors, contractors to do the work for you. And that's one of the reasons why we got out of it. We were having a problem getting commitments and doing quality work. And it was taking longer to get the jobs done. And finally, by accident with the Airbnb is how we got out of it. But it was something, we still had houses that instead of flipping, we turned into the Airbnbs. And I wasn't a proponent of I always was into long-term rentals in the beginning. That was for ages. Like I said, I worked in property management before, one of the largest companies in Connecticut. And so I was into long-term management. That was my field.
So the flipping, you saw the profit potential there. The construction work was a real challenge. And it sounds like the level of construction that you needed to do some of these flips was a lot more substantial than what you would need for, let's call it property turns, right? Or turning over the house for the next resident. And so I guess that's what led you to the short-term rentals. Could you talk about the pros and cons of the short-term rentals?
Short-term rentals are profitable, very active in where we are right now because of location. Sorry. The benefits are basically that the houses are busy all the time. I mean, because of location, we're near the University of Florida and consequently Shands and the colleges. So we have people coming in all the time, long-term, short-term. We have 7 of them right now. So, I mean, we have people come for a few months. We have people come for a week or minimum.
They're always maintained.
And they're always maintained. That is one of the things. My boss is talking to me about that.
Probably almost a decade. If she's brave, she'll come on camera too and say,
You got to come off the beach
You'll
first.
come on camera and say hi to Greg. She's in her construction clothes right now.
I'm in my
it's been way too long.
Yeah, it's a challenge. Let me put it that way. You're dealing with people all the time, coming in, leaving, coordinating. You know, it's a challenge with the Airbnbs. People coming in at 4 o'clock in the afternoon, people leaving at 11 o'clock in the morning, getting the houses ready, doing different things, and problems at a house or questions. It's my son basically is 24 hours a day, 7 days a week. You know, he takes care of that aspect of it. He's doing very, very good. Where I consequently, my field was cleaning houses, things like that. I have my sister-in-law owns a franchise cleaning service here in Gainesville. And I have other people that work on weekends and do different things for us. So we're able to coordinate that and do the quick turnovers.
So you're built to be active in this type of an investment, right? You've got the family all rallied around it. You've got the resources, you've got the experience, and you also don't have to have that level of construction in order to be in short-term rentals to make it successful. It can be really minor cleanings and maybe a little bit more than cleanings to get it going there for you. And it can't be lucrative, right? It can't be something that can provides additional rental income, but it would seem to me that it'd just be fair to say you got to go in with eyes wide open, knowing that it's going to be additional work. And if that is what you are built to do, it can be a great thing. If you're going into it thinking that it's going to be like long-term rentals and as passive as maybe your intention would be, you're probably going to be a little bummed about that component specifically. Would you agree?
Definitely, because Airbnb has different classifications. We are super hosts because you have to have a certain rating, and we have that higher rating. And to maintain it, you basically have to take care of people and be, your houses have to be in good shape and handle problems and do that, because if you get bad reviews, it lowers your rating. And if you're not a super host, you get lower, your houses come up lower on when they're looking for houses on the internet for those that are on Airbnb for that. So consequently, to maintain the super host, you're constantly on your toes to take care of problems and help people out, so. Yeah.
Bill, we got some questions flying in from our community here about the experience. If you don't mind me peppering in here.
Okay.
Lee Bishop, reigning MVP of the Not Your Average Investor Show community. Lee Bishop asks, Bill, how much work do you have to put into the houses in the Airbnb to turn it over? Is it more or less intensive than in long-term renting?
Week to week, month to month, you're constantly keeping up with it. We're on the long term, where we used to once a year we renew leases. Thank God. With Jacksonville Wealth Builders, it's every 2 to 3 years, because that is a major cost involved. So ours is on a short-term basis, and if you have the Airbnbs, you have the people to assist you in turning those over. It's not so bad. Especially, to give you an example, we just turned a house over with Jacksonville Wealth Builders. 2 weeks, it was turned over back on the market again and rented.
The funny thing is, Bill, we've been working together so long that I know what Jacksonville Wealth Builders is, but many people here aren't familiar with Jacksonville Wealth Builders. Of course, you can probably put it together here as JWB, but yeah, that was our original name of our company back in the day. And then we just realized that it was such a mouthful to say. And our email addresses used to end in jacksonvillewealthbuilders.com. Try typing that out times, 50 people that we had on staff.
I forgot about, to be honest, it's been so long.
It's been a while. You know what? Yeah. Whenever you start a company, you rebrand at least 2, 3, a dozen times, just figure it out.
Yeah. I'm going on 2 right now, and I'm only a year and a half in. So, Bill, Eddie Harris from Hotlanta has another question here. Is there any difference in tax structure on rentals versus Airbnb?
Yes, there is. And that's why we have a CPA that handles them, because of course, they're handled differently. And I'm not an accountant. Yeah, there is, and you'd have to look into it. There's advantages to both of them, but the long-term rental, I prefer the long-term compared to the Airbnb, which.
Yeah. There are additional taxes that are imposed when you have it under a certain number of days, when your leases are under a certain number of days. And I can't remember right off the bat what that is, whether that's 6 months or 3 months. I can't remember. But if you have short-term rentals, there's additional taxes that you'll want to factor in to the investment overall. So what you're going to hear a lot of from the short-term rentals is the gross rent that you collect is far and above the gross rent is far and above. Whoa. All right. You know what? Got a new studio here. I think it's all changing, all that good stuff. There we go. You know what?
There you go.
We're in the game. That's what we do here on live TV.
The counties are starting to add taxes also on top of it. Definitely, each county individually is starting to add additional taxes that are, adversely affecting what your profitability is. And then you have the state taxes also. So it's getting to be a little different management. Plus, municipalities are starting to invoke some length of stay.
Yeah, that's another thing. So in my community where I live, you can't do short-term rentals. They must be longer than 3-month stays. And so you'll hear this a lot. I was researching San Francisco. They have a lot of rules in San Francisco that would prevent folks from doing short-term housing Airbnbs like you would in many other places. Like, for example, you can only rent out a house for Airbnb short-term rentals if it is your primary home. And I think there's a maximum number of days that you could rent it out if you're not there as well. So especially in some of these municipalities, you want to make sure that you know the rules and the tax consequences, because that'll take away from the gross.
Definitely. Yeah.
Yeah. And John Tennyson also here in the Q&A writes that 12% resort taxes for rentals in under 6 months and a day as well. And John also has a question for you, Bill. He asks, Bill, would you recommend to partner with someone in remodeling businesses for flips?
Yes, if you have the right people. That's the main thing, is finding the right partner that you can work with. We had someone that that was working with us for a little while, and it just didn't work out, which consequently hurt us in our field. The whole thing is the coordinating it, amongst the two of you or whatever the groups that you're working with. If you could do it, it's excellent. But otherwise, it could be very nerve-wracking, I guess, or whatever. We haven't had any problems recently, though, doing it.
As right now that you bring up problems, I know that in our first couple of calls that we talked about, you had this story about how you had a problem early on with JWB, and because of that problem, that's the reason why you like him so much. You want to tell us a little bit about that?
Yeah. I owned my own business for a long time, and I'm going to be honest with you, is how you handle problems with a company is how the company is. And we had a problem with one of our first renters came in and left it in pretty bad shape, and we could not re-rent it for a little while. And JWB, we sat down and said, this is what we're going to do for you, Bill. We worked that out so that it was advantageous for both of us. And when they were willing to sit down and talk to me about that and getting things squared away, that's why I said I can do business with this company. And I'll be honest with you, I recommend them all the time, because when I had a business, I had customers that would recommend me. They would say, have people call me up anytime, and I appreciated that. So consequently, I have people calling me, asking me about my experiences with JWB, and I have no problem sitting down and talking to them, telling them the advantages that I've had. So.
Well, we appreciate that. You take your time to talk with potential clients that come through our onboarding process that we just want to talk to somebody who has been there before. And one of the reasons that we are so thankful that you do this is because you have been through really great times with us, and you have been through challenging times. And when we bring people on board, we want them to know that you're going to have both as a rental property owner. I mean, it is not a matter of if, it is when something happens in your rental property that frustrates you, meaning a resident may leave early. A resident may cause excessive maintenance items. And it's just really important for the long-term relationship to know that going in. Now, we have a lot of things to do to mitigate the risk of that. And, when you're committed to the long-term as far as a working relationship and as far as analyzing performance, then we have an opportunity to work really, really well together for a long time. Speaking of which, Bill, I took a look at your returns prior. Have you checked out your client ROI report at all lately?
Yeah, I haven't looked at it in a little while. Every once in a while, I'll sit down when I have time and look at it. But no, when I'm happy with something, I don't usually pay as much attention as when I'm not happy.
Well, I was looking in the first couple of years, and I think in the first 2 years we were underperforming. And we had a big turn. And then, part of what we asked you to do is to stay committed to the long haul, because we knew that real estate is best analyzed and you earn your best returns by holding on for a full market cycle. So you've been investing with us for about, I don't know, maybe 9 years now or so.
Well, yeah.
And not counting any home price appreciation, which, do you think that your house has appreciated at all in the last 9 years in Jacksonville, Bill?
It's almost double.
Yeah.
I look at that quite often, Greg. I do look at that. And
I bet it's fun. I bet
yes, yes, it is.
And you bought with conventional financing, which just increases your return on your investment. But not even counting any of that, your returns are over 20%.
Yeah, exactly. And when I look at that, I say to myself, why didn't I have them to do the more of this back then? 2020 hindsight, trying to look back on things, but you learn. And like I said, we have been very happy because of your people, your company, the people in your company are fantastic to deal with right now. Casey that I deal with right now, who's, if I have any questions, she says, I'm not sure, Bill, but I'll find out. I even went to look at one of our properties. She met me there, to look at the property.
Oh, nice.
I said, you didn't have to do that. She said, no, Bill, I'll find it. We did a walkthrough after it was ready to go. It's fantastic. She's great. She is great. I appreciate her. All of the people. So.
Did I hear correctly that he's got over 20% ROI without counting leverage?
Without counting home price appreciation.
So without counting home price appreciation, it's just on cash, tax benefit. Can you explain that a little bit, man? Like, I've never heard that. That's impressive.
You haven't heard it much, for sure. But if you bought properties in 2012, the returns then were better than they are today, right? Your purchase prices in 2012, you were near the absolute bottom of the Great Recession, right? 2010, 2011, 2012 was the absolute bottom. But rents were still wherever they are, right? Rents didn't drop during the Great Recession. They stayed here. Prices started here and then went down. So when your rent stayed here and your home prices were here in 2012, your cash on cash returns were so much higher than what you can get today. But what was different about that, right? And in 2012, people were really concerned. They thought real estate was never going to go up again in value, right? It's hard to think about it now, right? You have to have this perspective of living through full market cycles, putting your own money in there to see it. But at that point, it was a very different investment. The cash on cash returns made a ton of sense, right? 10, 15%, maybe even more were the expectations at that point. But people didn't know how to evaluate growth. Now, when we talk about all 5 profit centers here for making that same type of a decision in Jacksonville today, we openly talk about that cash flow is one of the smallest components of your overall total return on investment. And we've never been more confident that home prices are actually going to be going up, especially over the next year. So it's a different reality. People were making different decisions back then, but yeah, that's real. Bill and Ann and his family have earned over 20% returns. Not going to get that if you bought another one today. But when you look at the total return from all 5 profit centers, you still can get quite high and actually over 20% if you count all 5 profit centers versus just cash flow.
So what's the lesson in that? Bill, do you take anything from that experience in 2012 and the way that you made that decision making, and you apply that kind of like to what the market is doing right now? Is there any lesson learned to apply to today in decision making on how you're approaching your real estate portfolio?
At this stage of my life, I'm a little bit older now than back then in making decisions and at a point in my life, but I'm actually been driving around Jacksonville a little bit when I go up there, not as often, and contemplating getting involved with, especially on the west side, it's unbelievable over in Jacksonville. Mm-hmm. Getting with Gregg and seeing about some potential other houses up in the area to investments for us. I'm impressed with Jacksonville as a whole, as a city, the economy, the way things are going there in spite of everything else. Gainesville, we're all right, but Jacksonville, I'm really impressed with. So that's why we're interested in that.
That'd be great to hear a little bit more about from your perspective. You put money in both places, had success in both places. What about Jacksonville gets you so fired up now that you're thinking about investing more here?
My season tickets in Jaguars. No, I don't. We had them since the beginning, we continue to have them and look forward to it. But no, when I go through Jacksonville, my wife still will go shopping up there, and I'll take her up there and just I usually drop her off at the store. I don't go in stores, and I'll drive around looking at the properties in Argyle, the expansion in Argyle and West Side and other areas. I have not spent as much time on the east side as I'd like to. I go over there. I used to go over there more than I do now, but just the growth and the potential and the business factors grow, people coming into it, businesses coming into Jacksonville. It's amazing. So that's what I look at, the sustainability for someone, jobs for people, properties, that's what's important to me. So, yeah.
Sounds like you both get to do a little bit of window shopping. Not a bad deal. We got a bunch of, Lee puts in, is Bill still driving for dollars? That's funny. We got a bunch of questions in here, Bill. I'm gonna shoot some off at you. Joan Farwell asks, have you purchased a property that has a history of STR to add to your portfolio? I'm not sure what STR means. So if that can be explained to me by one of y'all, that'd be great too.
Short-term rentals.
Oh, yeah.
Yeah, I knew that. That was asking for a friend.
Yeah, I do too. Have we purchased the one that had a history of short-term rentals? Was the question?
Yeah.
No. Usually I'll be honest, the properties that we're focusing on now, we have friends that own properties or renting them before long-term. We rent them from the people and do Airbnb in them now. So we're doing Airbnb with former rental properties and doing Airbnb. So that's worked out very good for us with their friends of ours that we know. So.
All right. Interesting. Jay Patel asks, what are your thoughts on new constructions for rentals?
It's viable on the location. I mean, just your markets. That's the main thing, cost and what you want to look in, your return, what you're looking for. Short-term, long-term, how much work you want to put into it. It's up to you. I mean, you could do Airbnb, depending on the properties, you could do long-term rentals, but it's, what you're expecting for a return, I guess. Gregg can answer that. I mean, as far as that.
Yeah. I mean, we love new construction for rentals. It's something that JWB has believed in since 2011. It's interesting. Bill's house on India Avenue that he has with JWB, the turnkey property that he purchased, was part of ground zero when we're talking about this build to rent phenomenon. So builders building new construction homes, not to sell to homeowners, but to rent as a passive income stream. So Bill was one of the very first early adopters of new construction for rentals. I don't know how well he knew that back in 2011 or 2012, but yeah, we bought, I think it was about 48 lots in 2011. And that became, one of those lots became Bill's house on India. So we believed in it for a long time. You're just starting to hear now, especially over the last year or two, that the big money now believes in it as well. Hedge funds, private equity firms, REITs, big players now are trying to gobble up land so that they can build new construction rental properties. For us, this has worked for over a decade. We've been a big proponent of it. We love non-new construction homes too. This is a great point because a lot of times people will say, you know what, I think I should do new construction because I think it's going to appreciate more. Bill's homes, it was new construction in 2012. It's not new construction anymore, right? It's almost 10 years old, right? Bill's house has appreciated more in the last few years than it did in the first few years.
Definitely.
Right. So there's this idea that new construction leads to higher appreciation. We don't see any data on that. It would only be if you're looking to sell it after you buy it as new construction, right? Like the next year, you can still think of it as new construction. But when you own it for 10 years, there's really no difference as far as appreciation potential, as far as what we see when we track the market. So from an appreciation perspective, if you have the long-term outlook, I don't think there's a reason to go new construction versus renovation. And the great thing is that renovations and new constructions both get to the same risk-adjusted returns. It's just how you get there, meaning that new constructions are usually going to be a little bit more expensive and they're going to have higher property taxes, whereas renovations are going to be a little bit lower on the pricing scale, which is great because it produces more cash flow for you. And you'll have slightly higher maintenance costs on the renovation side. But it gets back to the 7 to 9%, which is our target not including home price appreciation. So we love them both. We have over 250 houses at the building department right now that are just waiting to get stamped for permits for new construction homes. We'll be building somewhere around 450 to 600 houses, new construction this year. So we love them, of course.
Right.
Yeah.
Did you have anything there to add, Bill?
No, I mean, we feel the same way. Our return, I look at annual return, but I also look at the appreciation. You know, they work together. You know, that's the key, you know, so we're investors, basically. That's our key.
You are not your average investor, Bill, officially, for the record. Denny Davis puts here in the Q&A, Gregg told me to buy more houses in 2012. I should have listened. I'm with you, Denny. I think I was on that one too. I had friends that were friends with Alex Safakis and saying that this was a good investment.
I remember that conversation, Danny. You don't know what kind of satisfaction that comment gives me. You know, 8 years later. No, I'm joking. You've done really, really well with your investments, Danny.
Well, he does have a question though. India Jasper neighborhood. How is that neighborhood looking these days? Bill, is that one of the ones that you drive, or maybe that's a question?
And I go through every once in a while, and I'll be honest with you, the tenant that we have in there right now keeps that. He was out cutting the grass the other time when I walked through. I was very impressed with our property there. You know, that's what I'm concerned with, our property.
Well, we'll talk about the rest of it, because I think it's important for people to know it's not going to be the best neighborhood out there.
It's not consistent. You see some that have cars parked out there that might not be running. They might be, yards might not be in the best condition. It varies from very nice to not so good.
You see mobile homes in different places in the neighborhood versus you seeing, you know, I mean, geez, JWB's probably built 200 new construction homes there in probably a half-mile radius. I mean, you have some older homes that are renovated. So you really have a mix in that neighborhood, which is the same, or probably, you know, it was the same as when we started to invest there back in the day, minus the new construction angle. You had more mobile homes and, you know, no new construction, or a lot less new construction. So Bill, let's go there. All right. You've met me and my team. You were just introduced to this luxurious office with this incredible parking situation. You're on this home buying tour. You're going through this neighborhood in 2020, 2012, mobile homes, houses that may be in disrepair, some really nice looking houses that are well kept, some houses that have people that have cars on the yards. Why on earth did you decide to put your money into that house on India?
It was a beautiful house. I mean, it was brand new, and we saw potential for that area. I mean, my wife, she's a lot smarter than I am. She liked the house, and she said, Bill, I think this is a very good investment. And I said, I liked it too. We saw potential there because we were investing on the west side mostly, but we wanted to start investing over on the east side at that point. And there were some things that came up, but we said, this and the houses surrounding it were all relatively new. If you remember, well, you know, Gregg, that were relatively new because I guess the developer had some problems and a lot of them were in foreclosure or bankruptcy.
Yeah, back in 2012 they were. 2011. Yeah. That's how we picked them up.
Yeah, and so we did. That was one of the reasons, and they were all relatively in good condition at that point too. Not the worst, but they were in pretty good condition. Even then.
The biggest thing is you were able to separate this investment opportunity from the place that you may want to live yourself. Exactly. And that's really important. You're able to make a decision that you did not put yourself in the shoes of your residents, which for better or worse, it doesn't matter if you did want to live there. If you don't, you just have to separate. And when you can do that, then you can make an independent decision of, is this going to be the best risk-adjusted return on my money? You felt good about the team. You felt good about Jacksonville overall. You wanted to diversify the neighborhoods that you were a part of, and you like the new construction angle. And so if you look at it through that lens, it makes sense, but only if you can objectively make this decision about the numbers. You have to separate yourself. You can't envision what you would like as your resident, or else you'll screw this whole thing up.
Well, we had sat down with you too, looking for projected rental and what it was going to cost and our mortgage and things like that. And we were looking long-term at that point. Compared to short-term, and that was important. So,
especially when we had an issue with your resident, then it became real important for you to think long-term. That really tested you, didn't it?
I had been in property management before, so I know those things happen. You know, so I understand that. So
you did. And you and Ann treated us with grace. We appreciate it.
All right, we got 5 really, really good questions here coming up for you. Lee Bishop asks, how many properties does Bill have, and how many Airbnb versus JWB passive rentals?
We have 12 properties, but most of them are in Gainesville now, the Airbnbs that we have. We have 4 in Jacksonville, well, JWB, excuse me. I'm sorry. JWB manages 3 of them. And one, we've had the same person in for 20 years, so I take care of that one. He's rented it for 20 years. So
that's pretty passive by itself, I would imagine.
Yeah.
It's a true resident. Ty Oladipo, welcome, Ty. Do you think consumers still desire walkability close to shopping, dining, etc., versus living further out and having to drive?
You want me to take that one?
Yeah,
from a macro perspective, yeah. I think you're starting to see, especially with millennials, starting to have more disposable income, starting to really kind of pave the patterns of buying more and more. They want thriving, urban, walkable downtowns many times. They want to be around places, and home ownership is not always as important to the millennial generation and younger. So you're starting to see real shifts. I think you definitely would like to cater to that. As we're starting to think downtown, JWB has 5 downtown acquisitions in Jacksonville that we have purchased in the last year and a half. And that idea, that mindset is there. It's the basis of a lot of that investment that we're making downtown. But I think it's important to separate the short-term rental and the long-term rental idea here. So like, for example, and Bill, I'd love for you to weigh in on the short-term rentals when it comes to walkability.
That is a key, especially in Gainesville. The location near UF is a lot of our houses are, and people desire that when they're coming in, visiting family or members in the hospital, sporting events. It has a lot to do with it, and that's why we try and center. There's certain areas like I don't know, you guys went to school in Gainesville, Duck Pond area down near downtown, and we have some houses there in different areas. So location is a key with Airbnb, definitely.
And for short-term rentals, I think it's paramount. For long-term rentals, it's not nearly as important, right? I would say that it would be wonderful if you had an investment that checked off every single box, right? But you have to be able to make some objective decisions as to what's really going to drive the best risk-adjusted return. Sometimes clients will come to us and say, hey, I really want to be around shopping centers, and I really want it to be walkable, and I want it to be next to this grocery stores and all this. And we just try to politely explain that we just haven't seen that is a strong correlation to being able to drive the best risk-adjusted returns for you for a long-term resident. Now, it's important to call it maybe a 15-20 minute drive from significant job creators. That's really important. But it's not so important, in our opinion, and what we've been able to do over the past 15 years, for you to be able to walk to this wonderful amenity that might be a shopping center in long-term rentals. There are just too many other things that are really going to drive your risk-adjusted rate of return, that you got to be willing to give up on maybe those things. And what we find a lot of when people are asking those questions, they're not able to do what Bill did. They're not able to separate themselves from this investment, right? They are not their residents. So for long-term rentals, I don't think it's really that important. You're able to do it get great risk-adjusted returns without those amenities, but for short-term, definitely. And then long-term, as we're starting to think about how Jacksonville can grow downtown, I think it is really important for us to be able to have those amenities within walking distance for our downtown population.
Yeah, makes a lot of sense. And Danny Davis puts here in the Q&As, goes, while that's true, buying properties through the lens of the resident, not yourself, you left out the part of the story that JWB as a company is not satisfied with just that lens. Your team is constantly trying to improve these neighborhoods in sometimes big and sometimes small ways. So yes, while an investor has to look through one lens, talk more about how JWB is constantly working to make these neighborhoods desirable places for anyone to live.
Well, thank you, Danny, for giving us the chance to chat about that. Yeah, I try to make sure that the mindset that people come in is one where we don't have too rosy of colored glasses, right? We need to understand that we're buying this investment property to produce a risk-adjusted return. But just like Denny mentioned, there is an entire platform that JWB has to be able to create real change and to really invest in our communities and be able to do some pretty incredible things. one of the opportunities that we've been able to really impact the neighborhood is Bill's neighborhood. And, like we talked about, when Bill purchased in 2012 and we started to make our big investments in 2011, there were a lot of homes that they were new construction, but there was a builder that was there. It just didn't work out. A lot of them were in foreclosure. It was certainly not an area that was, let's call it, on the radar for significant growth. Right? You could have chosen a lot of other neighborhoods in Jacksonville. And Bill, would you agree? So it was not one that was just kind of primed and positioned. JWB was able to go in there because we had the trust of so many of our clients, and because our clients have purchased so many homes with us. We've been able to build literally hundreds of homes in that area. And what happens every single time we build a house? We took the worst looking house on the block, or it was a mobile home, and that now has a brand new construction home, just like Bill's home. And, this is an area here where it's probably, mile square, mile radius around, right? And there's probably, I don't know, I'm gonna guess 1,500 homes there. And we just built 200 of them. And you took the worst looking ones and you made them the best looking ones. And it's clustered and it's under really wonderful property management. So there's standards that over time do improve the neighborhoods. And it's not something that we talk about a lot, because I don't want people to feel like that has to be the case for this investment to make sense. But when you're able to do this for 15 years, you're able to see how you actually have improved communities. I think about how that makes each one of these communities, the children in those communities are now a little bit safer, right? The children in those communities now have better, simple, just ways to be able to be educated more. I mean, think about, I'm a father. So when my kids are outside, if I had to worry about what they were doing or if they were going to be in trouble, it would constantly be a source of stress for me. Or, if they couldn't be able to do their homework in peace because things were going on outside, right? Like, that really matters to me. And so when we're able to have that type of an impact in these neighborhoods like Bill's neighborhood, or there's probably 3 or 4 other neighborhoods in Jacksonville that have had that type of an impact, it really, really matters. And it's just a byproduct of everything our entire network has come together to be able to do and impact Jacksonville overall.
Yeah, agree.
Yeah, vertical integration right there, man. Doing all the way down from the lot to the community, man. I love that story. Sean has a question. I'm gonna address this to you, Bill, and I'm sure Gregg will chime in. But he hears a lot about the downtown projects. Do you think this will have a positive effect? And he's mentioning College Gardens and Newtown neighborhoods in 32209. But Bill, as an investor, when you hear about the improvements in downtown happening by JWB and other parties, does that register for you as something that will impact your investments that you're making in the city?
To be honest, I'm not familiar with those areas. I was more involved with Avondale and Ortega and those places, and going downtown, I do on occasion, but not as often as I did before. So I really don't have the knowledge in that particular area. But Gregg would know more about that than me, of course.
Mm-hmm. Yeah, I think these will have an impact. It takes more than just JWB though, right? We need to have developers that go in with, first of all, it starts with our city leaders who are doing a great job with the strategic vision, right? You're starting to see how projects are coming online. You're starting to see incentive packages that are there for developers to take advantage of. You're starting to see the Emerald Trail come to fruition, which is this wonderful walkway that is going to be sprawling throughout downtown and connecting neighborhoods. And you're starting to see development go up or at least be proposed along the Emerald Trail. I mean, heck, JWB has purchased homes on Hogan Street in downtown Jacksonville. We have 3 of our investments are right there at the corner of Hogan Street. And that is along the Emerald Trail. That is this wonderful walkway that is being built out in the coming years to connect downtown and for our residents. So yes, I think those are going to impact the surrounding neighborhoods. Newtown is a surrounding neighborhood not too far from downtown. Same thing with College Gardens. Not all going to be impacted at the same degree, right? You have to kind of see where the development is going, see how close you are related to downtown. But some of those neighborhoods right there are definitely going to be impacted. And that's why we put all of our clients in those neighborhoods that are surrounding downtown. I mean, that's one of the reasons. Now, obviously, JWB sees an opportunity for long-term value and profit in doing these deals downtown. So it's not clearly altruistic or totally altruistic there, right? We are in this to make money with these investments as well. But there is also a part of this decision is about how can we make all of these neighborhoods go up for the 1,200 plus clients that we have that have single family homes in those surrounding neighborhoods, just like you mentioned, Sean.
All right. I'm going to ask one more question here from our old friend, Anonymous Attendee. He's from France. He has, Anonymous Attendee asks.
Never gets old.
It never gets old. It never gets old. Anonymous Attendee asks, you mentioned about reducing cash on cash and more focus on other types of return like tax benefits. What is the tax benefit for a W-2 employee who combined makes more than 200 grand a year? I couldn't find any tax benefit to reduce W-2 income by rental property write-offs.
It's a great question. I will first, of course, defer to a CPA to give you the real answer here. I am a rental property investor who's been doing it for 15 years, and I can speak from that lens, but I would certainly advise you to go and talk to a CPA. I'll give you my answer here. Your tax savings that we're talking about, and if you go and you look at your property evaluations, like for example, you can go to the property of the week and you can download the property evaluations that JWB puts together. Those tax savings we're talking about are not writing off your active income. We're not assuming that you're writing off your W-2 income, your active income. We're merely assuming you're writing off your passive gains, your passive income. So when you're depreciating the asset, means you're able to take the depreciation write-off. We're talking about that offsetting the rental income that you earned on the property, not offsetting the active side. And that's almost without exception, that's how our clients take advantage of this. There are ways for active real estate investors to be able to qualify to write off that against your active income. It takes a lot of, you have to devote a certain number of hours every year to real estate. You have to be active in the business to do it. So if you're like most of our clients, you're not there. You don't want to be active in the business. So just focusing on the passive write-offs will get you the risk-adjusted returns that we put in our evaluations. And if you'd like to go and see those, you can go and download our Property of the Week evaluations by going to jwbinventory.com. Our properties of the week are always there, and we now have the actual evaluations for you to be able to look at any time. So JWB Inventory.
All right, I put that there in the chat. Bill, you got any take on that?
I use my accountant as the person that guides me as far as that's concerned. Any questions I might have. So no, that I agree with Gregg on that. Yep, definitely.
Got it. Bill, so what's your, final question for you, man? What's your long-term plan? You got this nice little family business going on with short-term rentals. You got your buy and hold stuff. You still got that one property that has, that you manage that's got a resident in there forever. And you're kind of thinking about other rental income properties. Have the fact that you've held them for so long, I have to assume that you got a bunch of equity in there. Is that coming into your strategy of maybe acquiring more based on that equity? Kind of like what's your next year to 2 years outlook as far as investing in real estate goes?
Well, we've been fortunate in having property so long. Some of the companies we have mortgages have combined 2 mortgages on one property, and we own the other one free and clear, which has been advantageous to us. We have outlook for both. I mean, expansion in Gainesville and Airbnb, but I've been looking at the Jacksonville market and the appreciation we've gotten up in that market. And it's really, and the more I drive around Argyle and on the west side and see the growth there, the more I say there's a lot of potential in this area. And even on the north side, we have a tax property, and I've been going up in that area. And I said, wow, this has changed. I haven't been in the area. So there's so much going on that there's potential and long-term properties in the Jacksonville area also. So
you've always had the itch for Jacksonville properties, Bill. I don't know how long you're going to be able to avoid scratching that itch.
We may be going back soon. I know that's a fun potential.
Awesome. Bill, thanks a million for joining us, man. Like, this has been a really, easy conversation with you. I feel like there was a ton. I'm thinking in Spanish now. Ton of nuggets that you dropped there just on, experientially. You don't get a lot of people that you can just ask the real take on Airbnb versus long-term rentals versus flips, the experience that you've lived. I think that added a lot of context to our community. I know it's a lot of stuff that I haven't heard yet of somebody that's actually been in the trenches and can talk about how it feels and can speak honestly towards the idea of like, yeah, if you got a son taking care of it and, and your wife likes to, and your wife is multi-talented. But thank you so much for the candor. This was really, really, really great. Just a phenomenal conversation, and thanks to everybody that showed up. It's a Tuesday and we've had 50 people on with us for an hour. That speaks to the testament of the value that you're putting out there, right? So that's a real great validation of what that is.
Well, JWB, see that? I didn't say Jacksonville. So I've been with them for so long, and the people that I've been working with for so long, it's like I work with people. That's how I do things, and I enjoy doing this. When it was brought up, I said definitely I'd be interested in doing it. So again, thank you for giving me the opportunity just to spread what we've done.
It's been really incredible having you here, and going back over the years, I still remember sitting down with you and Ann like it was yesterday, and I remember going through the great times and some of the tough times, and building out the plan with you, and getting to know your family, and it's really wonderful that you continue to take the time, not just today, but you continue to take the time to talk to new folks that are coming on. I mean, these are the types of relationships that we aim to build. So please say hello to the family for me. Thank you so much for being here and for being a part of JWB. And, next time you're in Jacksonville, we'll go do some house hunting together. How about that?
Sounds great, guys. Thank you so much.
All right, Bill, great having you. I encourage everybody to join us in the Facebook group, jwbfacebookgroup.com. That's where we have 2,600 investors, just like Bill and other people that you see in the chat. That's where we interact on a day-to-day basis. Join us on Thursday when we actually break down a property. We call it the JWB Rental Income Property of the Week. So same time, Thursdays. Hope to see you there. And this has been awesome. Greg, I'll give you a final.
Just a few Q&A that came up at the end here. So we'll answer those. Easy one here for Joan Farwell. Joan, I think this is your first time joining the show. Thank you so much for joining. I know you mentioned you're from Jacksonville, so we hope to have you back here on the Thursday show. You asked if I do consults. I definitely make those available. You'll be talking to a team member of mine, and you'll have a wonderful time. The first person you'll be speaking with will either be Courtney or Brandon. Both will give you an introduction into JWB and really just kind of want to understand what your goals are so we can find out if it would be a great fit. So you can schedule a time to speak with our team by going to chatwithjwb.com. And we're looking forward to getting to know you a little bit better. So thank you so much. Oh, and you said I've done that. Fantastic. Well, we're looking forward to jumping on the phone with you. Nadeem asked, how many years can one write off depreciation? So again, talk to the CPA, Nadeem, but standard, and I don't know if standard is the right word when you get into like tax talk. There's different terms there, but the generally accepted way to write off is 27.5 years. It's written off over 27.5 years. I got some feedback that said that I shouldn't say standard when I'm talking about taxes from a well-respected CPA. So again, go talk to those well-respected CPAs, but you typically write off your depreciation over 27.5 years. So basically what that means is you take the building value and you're able to divide that by 27.5 years. And every year you're then able to use that amount as a write-off. Again, talk to somebody who makes their life work being an accountant, but that's generally what you'll do there. And then Lee Bishop asked, Greg, is Jacksonville sprawl making the city look like it is expanding, making walkability more of an issue with the JWB houses? No, right? So the downtown area where becoming a urban, walkable, vibrant area is really important for us to attract top talent to our city. That is a great opportunity for us to make sure that we can rise median incomes and watch rents and home prices continue to rise. Because if you don't, eventually, no matter what supply and demand does, if people can't afford the houses, then home prices and rents won't go up. So that is why it is so important. It's why you see JWB making such an investment in downtown for the long-term health of the city, of us, and our clients. But our areas, our neighborhoods are located, let's call it 10 to 20 minutes away from Jacksonville, the downtown areas. And it is not critical for those to become urban, walkable. It's a different place. And those neighborhoods are wonderful for what they are. They produce the best risk-adjusted returns that we can find here, and they're cash flow positive. So that's why we put you there. But it's not a huge focus to make those the same type of urban and walkable environment. And with that, I think we will send everybody off. So we will hope to see you again Thursday at 12:30 Eastern on the next edition of the Property of the Week.
Week. Way to over deliver, GC. See you later, Bill. Thanks.
See ya.
Hey, thank you guys. Good seeing you. Take care.